Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, an introduction into life insurance, part 2 of our series on life insurance for indemnification, income, and inheritance. Welcome to segment 2 as we continue doing an introduction into life insurance. And these are major considerations that you have to think about, and they're not easy sometimes. The first one is policy owner. Remember, whoever owns the policy, whatever taxable events are going to be there, will be the policy owner. So when I'm looking at policy owner, who shall be the policy insured, the policy owner, the policy beneficiaries, the policy payor? Who's going to pay for it? Who's going to own it? It could be the same people. But remember, most of the time, you could have a simple policy owner, policy payor, policy insured. They could all be the same person, and then they'd have their beneficiaries as they see fit. If you're a father and a mother, you're going to indemnify yourself, indemnify your children if something happens to you. So you could be the policy owner. If you're married, you may want to think about cross-owning. I own my wife's, my wife owns mine. You might want to look at the ramifications. Remember, every state's different. I just happen to live in a community property state. You may want to look at it, but ownership issue is a tax issue. In your mind, think if I own it, if there's any tax ramifications of the policy, and there could be depending upon what you're trying to get done and how big your estate is, you just need to look at policy owner, policy insured. Who's the actual life insurance going to be on? Hopefully it's a breadwinner, a rainmaker, a home administrator, somebody at your office that's running operations. You want to pick key people that are earners to be your policy insured. And of course, then your beneficiaries. Who's going to benefit? And remember, underwriting is going to come back here and say, why is this person benefiting from your death? Is there any economic justification for putting insurance on yourself and then in turn assigning these people as direct beneficiaries of your death benefit? So that's one big thing. What type of policy? Well, it depends. Are we doing a temporary coverage or are we doing permanent coverage? If we're doing temporary coverage that we're not going to have for the rest of our life, then we need to look at term insurance. I like to call it temporary expense reimbursement money, TERM, term. And remember, there's a lot of there's annual renewable term, there's 5-year term, all the way up to some carriers even show 40-year level term, depending upon the age. Then you want to know how much. If you've never done a quantifiable, a scoring or an actual way to measure, you could list all your present obligations, debt, mortgage, all your future obligations like weddings, if you have daughters, college education, retirement, if you want to look into the future. If you have charities depending on you, you may want to also put that in there as well because you're trying to figure out how much life insurance do I need? If something happened to me, who would suffer? My family beneficiaries, my actual, maybe I'm an owner with somebody else in a business. I have to figure out everybody that could be hurt by my untimely demise. So I want to look at how much insurance. I have a form for this that you could use to calculate and get to a decent number. And remember, don't forget to add human capital. Human capital is a huge issue. Almost everybody does their debt. They accumulate their future obligations, but they forget there's earning power here. So if I died at 30, I'd have still 35, maybe even 40 years of earning ability. I need to cover that because it's not only taking care of debt, it's also taking care of future obligations. And my household's used to having income come inside to take care of the normal monthly expenses. So human capital, whether it's business or at home, is a major issue, and you need to be able to quantify it. I have an actual calculation for this, a worksheet for this. If you want to ask me for it, just write me, steve@lifesizesolutions.com, and I'll be happy to send it to you. And then, of course, beneficiaries. Again, underwriting of a life insurance company is going to come back and say, are these beneficiaries, will they affect loss? Like if you're a young parents and you have children, your children are the beneficiaries of your death benefit. Yes, those proceeds will go to those children. That is completely justifiable. If you have business partnerships that you're trying to indemnify each other, that's completely justifiable. When you get outside, there's other areas where you have to always prove there's justification needed here. Who's going to suffer loss if that person dies? If you're a beneficiary of somebody that's questionable, hey, the underwriter's going to say, what is the economic loss? So always remember, I have to justify this financially. The basic 3 product lines are term life insurance, and then there's permanent life insurance, and then there's multi-life insurance. Multi-life insurance has 2 lives on 1 contract. You could have a first to die contract. Whichever one dies first pays. You could have a second to die contract. Whoever dies second will pay. Both of these have areas in planning scenarios that you want to look at. And I like second to die personally because it does estate planning. It does creates an estate. It takes care of the charities that I deal with. And the economic leverage of a second death policy is so unbelievable from an economic point of view. Most people like to look at that. Now, from permanent life, there's really 4 basic permanent life insurance contracts that are out on the street right now. You have participating whole life, you have universal life, you have indexed universal life, and you have variable universal life. Those are 4 different forms of permanent insurance. Some people gravitate more to a conservative platform like participating whole life, or some are more aggressive, they're younger, and they understand the risk tolerance. They may be looking at variable universal life. It just depends upon, again, your propensity for risk. And then you're going to have annual renewable term, and as I said earlier, some of these contracts, depending upon your age again, could go out to 40 years. So most of the ones that I see that are long-term are 30-year. The only caveat I say when you're buying term is, keep in mind, your temporary expense reimbursement or your temporary liability may actually migrate and evolve into a permanent. So I want to have a conversion window here where I can convert without insurability. And you always want to say to whoever you're dealing with on this, does this contract allow me to convert without showing any insurability? I need to know that just in case I need this. And remember, if you put waiver of premium on this, if you became disabled, you could convert that contract. That'd be a huge opportunity. So you just want to make sure that when you walk through on term, I have nothing wrong with term insurance, just make sure it has a conversion privilege or provision inside it. And remember, there's many policy riders. I just named one, waiver of premium. Another one's disability. What if I became disabled and I couldn't pay it? These are all these riders. There's chronic illness riders. There's long-term care riders. There's term riders on top of this. In permanent whole life, there are paid-up addition riders on top of that. So there's all kinds of ways to be able to use the policy to function on your economic benefit. And then when we're looking at the 4 products, again, par whole life, universal life, index universal life, and variable. These are all cash value contracts. And if you're going to use these cash value contracts for a retirement supplement program to go along with your 401k and other investments for retirement, just keep in mind, you want to be able to use the one that actually fits your suitability and your risk tolerance profile. It's really important to look at these 4 products and see which one really is going to serve you best and which one it fits your financial profile, your suitability, and most importantly, your timeline. And then these are the 3 planning scenarios. Anytime I'm looking at a planning scenario with life insurance, I divide it into 3 macro categories. The first one is indemnification. I'm looking for protection. I'm looking for coverage. The second one is tax-free income. There's a huge ability here to write a really great policy. The mechanics are there. You have to have a good designer, a person who understands the laws. Tax-free income could be huge. And remember, tax-free income, withdrawals to basis, and policy loans to gain from a life insurance contract that's TAMRA compliant. That money not only comes out tax-free, but it's one of only 4 different tax-free items that doesn't count for the Social Security provisional income test. Remember, everything else does. So if you have income from a qualified plan, that can cause your Social Security, not only your qualified plan taxed, your Social Security benefits could be taxed because of your qualified plan income. But for income from life insurance for tax-free purposes, it does not enter into the provisional income test. So all that money comes free and it doesn't dicker with your Social Security. And then inheritance. Some people, I could create people that say, I have no money, Steve, but a little bit of premium, a little bit of cash flow can create a legacy. I've seen people who have big hearts and small wallets use inheritance and life insurance and pay $300, $500 a month because that's what they can afford to be able to give anywhere between $250,000 to $500,000 in their heart for their charity or their children or their grandchildren. And you can even use inheritance to fund a foundation. Let's say you want to make your own charitable organization that you can get approval from the IRS. Once you get that approval and foundation, you can even have your children be the employees of that foundation. There's a lot of things to do in inheritance. And again, as I said earlier, I want to use second to die on this deal because I think it's huge and a great opportunity to use leverage. It's probably the most leveraged contract, and especially when we're talking about transfer of taxes, transfer of monies, asset transfer, creating a legacy, helping out a charity, or forming my own foundation. This is an excellent tool. So again, We're looking again at basic premise or basic ideas that you can use life insurance in full-blown planning, whether it's indemnification, income, or inheritance. Don't forget to watch our next segment on protecting human capital with economic leverage, part 3 of our series on life insurance for indemnification, income, and inheritance. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.